I want you to look past the headline for a moment. The headline says President Trump signed an executive order creating a new retirement account. The headline says Americans may soon have access to something being called the Trump IRA. The headline says this could help workers who do not have a 401k, that is the surface. But the real story is larger than a retirement account. It is about how the government tries to solve an access problem by creating a new investment channel. It is about how money moves into the stock market. It is about how fees silently drain wealth. It is about how the government funds promises it cannot currently afford. It is about debt. It is about inflation. And most of all, it is about understanding the economic machine so you are not simply acted upon by it. Most people will hear about a new retirement account and think only one thing. Can I get free money? That is understandable. If the government says it will match part of your contribution, people naturally focus on the match. But I want you to think one layer deeper. Free money is never truly free inside a system. Someone funds it, someone receives it, someone borrows for it, someone pays the inflation costs, someone benefits from the asset flow, someone gets diluted. That is how economic systems work. There are always cause and effect chains. And if you do not understand the chain, you may celebrate the benefit while missing the cost. So let us examine the Trump IRA in that way. Not as politics, not as a slogan, not as a reason to cheer or panic as a system. The stated problem begins with the 401k. A 401k is one of the main retirement vehicles for American workers. It lets people contribute money from wages into an investment account designed for retirement. In a traditional 401k, contributions can go in before income tax. The money grows inside the account, and taxes are paid later when withdrawals happen in retirement. In a Roth 401k, contributions are made with after-tax dollars. The money grows inside the account, and qualified withdrawals can come out tax-free later. The basic idea is powerful. A worker earns money. Instead of spending all of it, the worker places some into a long-term investment machine. The account compounds over decades. The worker reaches retirement with accumulated capital. That is the theory. And when it works well, it can be a very good system. But the 401k has problems. The first problem is access. Not every worker has one. If you work for a large employer with a strong benefits package, you may have a 401k. You may even have an employer match. But if you are a gig worker, an Uber driver, a part-time worker, a low-income worker, a contractor, or someone employed by a small business that does not offer a plan, you may have number 401k at all, according to the source document. The Trump administration says roughly 56 million workers do not have access to a 401k. That is not a small number. That means a large part of the labor force is outside the main employer-based retirement machine. And when you are outside the machine, you often miss more than the account. You miss the automatic payroll deduction. You miss the employer match. You miss the default path into stocks and bonds. You miss the behavioral system that makes saving easier. This matters because retirement success is not only about knowledge, it is about infrastructure. If an employer automatically enrolls a worker, deducts money from payroll, offers a match, and makes the process easy, that worker is more likely to invest. If the worker has to figure everything out alone, open an account, decide what to buy, remember to contribute, and do it consistently while living paycheck to paycheck, the odds are lower. Access matters because behavior matters. The second problem is fees. Fees sound small when they are stated as percentages. 1%, 1.25%, 1.5%. People ignore them because the number looks tiny. But fees are not tiny when they compound for 30 years. A fee is not only money paid once, it is money removed from the compounding machine. Every dollar paid in fees is a dollar that no longer grows. And the lost growth on that dollar is also gone. That is why fees are dangerous. The source document cites an average 401k fee of about 1.26% in 2025. That may not sound dramatic, but over a working lifetime, it can remove an enormous amount of wealth. The example in the source document is simple. Imagine investing $500 per month for 30 years. Assume an 8% annual return before fees. Without fees, that grows to around $679,000. But if the account pays an average fee around 1.26%, the ending balance falls to around $540,000. That means roughly $139,000 is lost to fees over the period. $139,000. That is not a tiny administrative cost. That is a chunk of retirement. That is a college fund. That is years of living expenses for some households. That is the difference between more security and more dependence. This is why low fees matter. The source document says the Trump IRA would cap fees around 0.15%. Using the same example, the ending balance would be closer to $660,000, and fees over the period would be around $19,000. That is a radically different outcome. The investment return assumption did not change. The contribution amount did not change. The time period did not change. The fee changed. And because the fee changed, the ending wealth changed. That is one of the most important lessons for any investor. You cannot control the market. You cannot control the economy. You cannot control whether the next decade is better or worse than the last decade, but you can often control fees. You can choose lower cost funds. You can read expense ratios. You can avoid overpriced products that do not provide better outcomes. You can ask whether the fee is worth it. Sometimes a higher fee may be worth paying if the manager truly adds value, controls risk, improves tax outcomes, or provides services that justify the cost. But most people never ask. They simply accept the menu given to them. That is not thinking like an investor. Thinking like an investor means understanding what every basis point costs over time. The third 401k problem is portability. A 401k is usually tied to the employer. If you leave the job, the plan may remain behind. You may be able to roll it over, but the process can be confusing. People forget old accounts. They leave money in plans with high fees. They feel stuck. They do not want to change jobs because they do not understand what happens to the account, or they move from job to job and end up with scattered retirement balances. This is inefficient. Money should not become trapped in administrative friction. A retirement system should be portable because workers are portable. The modern labor market is not built around one employer for 40 years. People change jobs, they contract, they freelance, they drive, they deliver, they consult, they move, they combine income streams. A retirement account linked only to one employer does not fit the modern reality for many workers. This is where the Trump IRA is being framed as a reset. It would not depend on the employer offering a plan. It would be available to workers. It would be portable because it would not be tied to one job. It would have low fees. It would allow small minimum contributions. The source document says a worker could start with as little as $5. That matters because minimums create psychological barriers. If someone believes investing requires $100 a month, they may never begin. If they can begin with $5, the barrier is lower. The amount is not the point at the beginning. The habit is the point. A $5 start will not fund retirement by itself, but it can create identity. It can create the first connection between labor and ownership. It can move a person from no investing to some investing, and that is a meaningful transition. Now, the feature most people will focus on is the government match. The source document says that under the proposal, the government could contribute up to $1,000 per year for qualifying workers, but it is not simply a free $1,000 handed out regardless of behavior. To qualify for the full match, the worker must meet income limits and contribute enough of their own money. For a single filer, the full benefit applies under income around $2,500 for married filers. The full benefit applies under around $41,000. The benefit then phases out for single filers. Some government money may still be available up to around $35,500 of income. For married filers, the phase-out may extend to around $71,000. The match is described as 50% up to $1,000. That means if a qualifying worker wants the full $1,000 from the government, the worker would need to contribute $2,000 during the year. $2,000 contributed by the worker, $1,000 from the government, $3,000 invested. That is significant for a low-income worker. For someone making $20,000 or $30,000 a year, $2,000 is not easy. That is a real sacrifice. But the match changes the economics. A 50% match is powerful. If you contribute $2,000 and receive $1,000, that is an immediate 50% return before market performance. That is why employer matches in 401ks are so valuable. This is similar, except the match comes from the government rather than the employer. And that is where the analysis must go deeper. Because the government does not have magic money, it has tax revenue, it has borrowing, it has printing through the monetary system. Those are the sources. The United States government already spends more than it collects. The source document uses rough 2026 numbers, about $5 trillion in tax revenue, about $7 trillion in spending. That leaves a $2 trillion gap. That gap is a deficit. The government fills the gap by borrowing. That is the basic structure. If the government adds a new program that contributes money into retirement accounts, expenses rise further. If taxes are not raised, then the funding must come through more borrowing. The source document emphasizes that taxes are unlikely to be the funding source because Trump signed major tax cuts through the One Big Beautiful Bill Act. So the remaining likely path is more debt. More debt must be financed. The government can borrow from individuals, institutions, foreign countries, or the Federal Reserve System if private and foreign buyers do not absorb enough Treasury issuance. The Federal Reserve can become a larger buyer by creating money and purchasing government debt through mechanisms that expand the monetary base. People call this printing money. Technically, the mechanics can be more complex. But the economic point is the same. New dollars are created to support government borrowing, and when dollars are created faster than real wealth, the purchasing power of existing dollars is diluted. That is inflationary pressure. This is the most important trade-off. The Trump IRA may give money to qualifying workers. That money may help them invest. It may broaden access. It may reduce inequality in retirement account participation. It may push more people into asset ownership. Those are benefits. But if the program is financed by additional deficits and money creation, the cost can appear through inflation. Inflation is not a line item on the program budget. It is a tax hidden in prices. It reduces the purchasing power of wages, cash savings, and fixed incomes. The people who own assets may benefit because more money flows into assets. The people who rely only on salaries and savings may lose purchasing power. That is the paradox. A policy designed to help low-income workers can also contribute to the inflationary environment that hurts low-income workers most. That does not mean the policy has no merit. It means it must be understood as a system with trade-offs. There is no free lunch. There is only a transfer, a financing method, and a consequence. Now let us examine the stock market impact. The source document estimates that the Trump IRA could bring somewhere between $32 billion and $68 billion of new money into the stock market. That estimate should be treated cautiously because the program is new and the actual participation rate, contribution rate, and implementation details matter. But the direction is what matters for the analysis. If a new account increases access, lowers fees, allows small contributions, and includes a government match, more people may buy stocks. More buyers means more demand. The stock market, like any asset market, responds to supply and demand. If more money flows into stocks and the supply of high-quality public equities is not increasing at the same pace, prices can be supported. This is one of the reasons retirement systems matter so much to markets. 401ks helped create a structural bid for equities. IRAs helped create a structural bid. Automatic payroll contributions create ongoing demand. Free brokerage apps created easier access and new waves of retail participation. The Trump IRA could become another channel. It could take workers who were outside the employer plan system and pull their contributions into the stock market. It could also add government matching dollars to that flow. That is important. Every month, more money could enter index funds, mutual funds, and ETFs. Some of that may go into total market funds. Some may go into SP 500 funds. Some may go into target date funds. Some may go into low-fee index options. But the broad effect is more retirement-directed buying. This does not mean the stock market only goes up. That would be a dangerous misunderstanding. Markets can still crash. Recessions can still happen. Valuations can become stretched. Inflation can hurt multiples. Interest rates can rise. Earnings can disappoint. Geopolitical shocks can hit. A new retirement account does not repeal the business cycle. In fact, when more free or subsidized money enters an asset market, volatility can increase. Flows can push prices higher during optimism. Then fear can create sharper drawdowns when conditions reverse. More access creates more buyers. It can also create more emotional sellers during stress. This is why financially savvy people do not hear the words new retirement account and conclude, buy everything immediately. They ask how flows will work. They ask where the money will go. They ask whether valuations are already high. They ask whether the money is financed by debt. They ask how inflation responds. They ask how volatility changes. They ask which assets benefit from the flows. That is how investors think. Now, what assets could benefit? The most obvious beneficiaries are broad U.S. stock market funds. A total market fund such as VTI gives exposure to thousands of U.S. public companies. If more money flows into the overall market, a total market fund benefits from broad participation. An SP 500 fund such as SPY gives exposure to the 500 largest public companies in the United States. Because retirement flows often concentrate in large index funds, the biggest companies can receive a large share of passive inflows. That is already true in the current system. More automatic investing often means more buying of index products. More buying of index products often means more demand for the companies inside those indexes. The largest companies receive much of that flow because market cap weighting directs more dollars toward companies that are already large. This can reinforce concentration. It can push mega-cap stocks higher when inflows are strong. It can also create risk if valuations disconnect too far from fundamentals. Again, every benefit has a risk. Passive flows can support markets. Passive flows can also make the market more dependent on continuous contributions. If those flows slow during recession, prices can adjust. The point is not to blindly buy because money is coming. The point is to recognize where the river may flow. In investing, you want to own where long-term money is moving, but you also want to understand price. A great flow story can still be a bad investment if you overpay. A good investment usually requires both a sound asset and a reasonable entry relative to long-term value. Now, the Trump IRA also changes the political economy of the stock market. The more Americans own stocks through retirement accounts, the more political pressure there is to protect the stock market. This has been building for decades. When retirement is tied to equities, the stock market becomes not only a private investment market, but a public confidence mechanism. A crash hurts household wealth. It hurts retirement security. It hurts consumer confidence. It hurts political approval. That creates pressure for policymakers to support markets through lower rates, liquidity stimulus, or other tools during crisis periods. This is not conspiracy. It is incentive. When the stock market becomes central to household retirement, the government becomes more sensitive to asset prices. The Trump IRA would likely deepen that relationship. More workers connected to the stock market means more people affected by market movements. That can be good because it broadens asset ownership. It can also increase dependence on financial markets. If wages are weak but asset prices rise, investors benefit. If people do not own assets, they fall behind. A program like this could help some low-income workers become owners. But if it is financed by inflation, those who still fail to participate may be hurt even more. This is why financial education matters. The system rewards asset ownership. If you only hold cash and wages while money is being created and pushed into assets, you may lose purchasing power. If you own assets, you may benefit from the inflation of asset values. This is one of the great divides in the modern economy: workers versus owners, cash holders versus asset holders, wages versus compounding. The Trump IRA is, in one sense, an attempt to move more workers into the ownership side. That is good. But the funding mechanism may also make ownership more necessary because inflation punishes those who do not own assets. That is the irony. The same policy can be both a ladder and a pressure. A ladder for those who use it, a pressure for those who cannot or do not. Now let us return to the word free. The source document says the most expensive kind of money is free money. That is a provocative phrase, but it contains truth. When money is called free, people stop asking who pays. If the government gives a match, taxpayers pay. If taxes do not rise, borrowers pay through future debt. If debt is monetized, everyone holding dollars pays through inflation. If inflation raises asset prices, owners benefit and non-owners lose relative ground. So the word free hides the chain. A disciplined mind never stops at free. It asks free to whom, funded by what, and paid by whom later. This is the same logic I use for all policy analysis. A subsidy can be useful, but it changes incentives. A tax cut can stimulate, but it can widen deficits. A government match can encourage saving, but it can require borrowing. Borrowing can fund investment, but it can weaken currency value if excessive. Inflation can lift asset prices, but it can hurt wage earners. Everything connects. Now, what should an individual do with this information? First, understand your current retirement access. Do you have a 401k? Does your employer offer a match? What are the fees? What funds are available? Are there low-cost index options? Are you contributing enough to get the full match if you have access to a 401k match and you are not taking it? That is often leaving money on the table. The Trump IRA does not eliminate the value of existing employer benefits. It may help those outside the employer plan system, but anyone with a strong 401k should still evaluate the match tax benefits and fund choices. Second, examine fees. Do not assume your 401k is good because it exists. Do not assume it is bad because some plans are expensive. Look at the expense ratios. Look at administrative fees. Look at fund options. A fund charging 0.03% is very different from one charging 1% or more. If a higher fee fund is truly better, it must earn that fee. If it does not, the fee is a silent wealth transfer from you to the financial industry. Third, understand portability. If you have old 401ks, know where they are, know the fees, know whether you should leave them, roll them into an IRA, roll them into a new employer plan, or consolidate. Do not let old accounts become forgotten accounts. Fourth, if the Trump IRA becomes available and you qualify, understand the match rules. If the government offers a 50% match up to $1,000 and you qualify by income, the match can be powerful. But you still need to contribute your own money. If you cannot contribute $2,000, you may not get the full $1,000. If you contribute less, you may get less. The details matter. Fifth, do not treat the account as magic. An IRA or 401k is only a container. The investments inside the container matter. Fees matter, asset allocation matters. Behavior matters. If you use a low-cost account but buy poor investments or sell during crashes, the account cannot save you. Sixth, think about inflation. If government policy creates more debt and money creation, cash loses purchasing power. That makes long-term asset ownership more important. Broad stocks, productive businesses, real assets, and other inflation. Aware holdings may be part of the solution. But risk must be managed. Seventh, prepare for volatility. More access and more money can lift markets, but they can also create larger swings. Market crashes will still happen. Recessions will still happen. The key is not to avoid all volatility. The key is to use it. When markets fall, disciplined investors can buy good assets at lower prices. This is why recessions and crashes often create millionaires. Not because crashes are pleasant, because they transfer assets from the fearful to the prepared. Now, let us explore the fee issue more deeply because it is one of the most useful practical lessons in the entire source document. If you invest $500 per month for 30 years, your total contributions are $180,000. The rest of the ending balance comes from compounding. The greater the fee drag, the less compounding you keep. A 1.26% fee does not take 1.26% of the ending balance once. It takes a slice every year. Every year, it reduces the base. The reduced base compounds less the following year. Then fees are taken again. This repeats for decades. That is why small fee differences create large wealth differences. People often focus on market return. They should also focus on net return. Gross return is what the asset earns. Net return is what you keep after fees, taxes, and mistakes. Wealth is built from net returns, not gross returns. This is why low-fee index funds became so powerful. They allow more of the market return to remain with the investor. The financial industry used to extract high fees from people who did not know better. Some still does. If a new retirement system caps fees at 0.15%, that can be beneficial for workers who otherwise would be stuck with expensive products. But again, the cap is only one piece. The investments still need to be appropriate. The investor still needs to contribute. The account still needs to be held through volatility. The government match still needs funding. The system still has costs. Now let us think about minimum contributions. The source document mentions that some 401ks or investment options may have minimums such as $50 or $100 per month. The Trump IRA is described as having no meaningful minimum, allowing investments starting around $5. This matters because participation often begins with psychology. A person making $30,000 a year may look at a $100 monthly minimum and think, I cannot do that. So they do nothing. If the minimum is $5, they may begin. Once they begin, they may increase later. The first contribution is not about size. It is about crossing the line between non-investor and investor. That identity matters. A person who invests $5 is not financially free, but he has entered the ownership system. And once he sees the account, the match, the balance, and the habit, he may grow into larger contributions. This is how access can change behavior. But the program must be designed, well, low. Income workers need simplicity. They need low fees. They need default options that do not expose them to reckless risk. They need education. They need protection from predatory products. They need clear rules around withdrawals, penalties, taxes, and match eligibility. If the account is too complicated, participation suffers. If the investment menu is too confusing, people may make poor choices. If workers withdraw early because of emergencies, the retirement benefit may be weakened. This is why access alone is not enough. Good design matters. Now let us think about the inflation side again. The government already has a deficit. If it adds spending without raising taxes, debt rises. If debt rises enough, interest costs rise. If interest costs rise, deficits can grow further. If deficits grow further, borrowing increases. If borrowing becomes difficult, the central bank may be pressured to support the debt market. If money creation supports government borrowing, inflation risk rises. This is the debt cycle. I have spent much of my career thinking in cycles. Debt creates spending power today, but debt also creates future obligations. If borrowed money funds productive investment that increases future income, the debt can be manageable. If borrowed money funds consumption without raising productivity, the debt burden can become heavier. A government match into investment accounts has a mixed character. On one hand, it helps households buy productive assets. That could strengthen household balance sheets over time. On the other hand, if it is funded by debt and money creation, it can dilute the currency. The benefit goes to participants. The inflation cost is spread across everyone. That is why the distributional effect matters. People who qualify and participate may come out ahead. People who do not participate may bear some inflation cost without receiving the asset benefit. This is how policy can widen the gap between those who understand the system and those who do not. Financial education becomes even more important when governments create programs that push people into markets. If people understand the system, they can use it. If they do not, the system uses them. Now, what does this mean for the stock market? It means there may be a new structural buyer beginning around 2027 if the program launches on schedule. Workers outside the 401k system may begin contributing. Government matches may add more money. Low fees may make index products more attractive. More money may flow into broad funds that can support market demand, but investors must not confuse flow support with fundamental value. Stock prices ultimately depend on earnings, interest rates, liquidity, inflation, investor sentiment, and policy. Flows can push prices higher, but if earnings fall or rates rise, stocks can still decline. If inflation rises because the program is debt-funded, the Federal Reserve may keep rates higher. Higher rates can pressure valuations. So the same policy that sends more money into the stock market can also create inflationary pressure that hurts the stock market through rates. That is the kind of tension people miss. Economic systems often contain opposing forces. More buyers can lift prices, more inflation can pressure prices. More access can broaden ownership, more debt can weaken currency, more retirement savings can improve household balance sheets, more money creation can punish cash savers. The outcome depends on which forces dominate over time. This is why I do not think in slogans, I think in probabilities and linkages. Now, the source document points to simple ways to own the American stock market, such as VTI and SPY. That is a reasonable starting framework. VTI gives exposure to the total U.S. stock market. SPY tracks the SP 500, the 500 largest companies in the U.S. stock market. These are broad, liquid vehicles. They are not risk-free. If the stock market falls, these funds fall, but they avoid the need to pick one company. For many ordinary investors, broad market exposure is superior to guessing which stock will win. The average worker using a retirement account does not need to become a stock picker. They need time, diversification, low fees, and discipline. That is the advantage of index investing. You own the market. You do not have to outsmart every professional. You do not have to follow every earnings report. You do not have to predict every recession. You buy productive assets broadly and hold through cycles. Again, there will be losses. Every investor loses money at some point in market value. The question is whether the investor has the time horizon and emotional discipline to hold through those losses. The source document makes the point that crashes create opportunity for financially savvy investors. That is true because when good assets fall, future expected returns can improve. But that only helps people with cash, discipline, and a plan. A crash does not help the person who panic sells. It helps the prepared buyer. So if the Trump IRA brings more people into the market, those people also need to learn how crashes work. They need to understand that a retirement account is a long-term machine. It will go down. Sometimes sharply, the right response is not always to sell. Often the right response is to keep contributing. That is how retirement investing works. If the government broadens access but people do not understand volatility, they may enter the market, experience a crash, and leave at the worst time. That would be tragic. Access without education can create disappointment. Access with education can build wealth. Now let us talk about how this could affect inequality. The existing retirement system already favors people with stable jobs, good benefits, high income, and financial knowledge. They get employer matches. They get tax advantages. They invest early. They own assets. Those assets rise over time. People without access do not participate. They hold cash. They live paycheck to paycheck. They miss compounding. They fall behind a government-matched IRA for lower income workers. Could reduce part of this gap by giving non-401k workers access to a match-like benefit. That is the positive side. But if the government match is funded through money creation and inflation, and if low-income workers still cannot contribute enough to receive the match, then the benefit may not fully reach the people most in need. A person earning $20,000 a year may find it hard to contribute $2,000. That is 10% of income before taxes and living costs. If they cannot contribute enough, they may not receive the full match. So the program design matters. A match rewards contribution, but those with the least spare income may struggle to contribute. This is always the challenge with match savings programs. They help those who can save, they do less for those who cannot. That does not make the program bad, it makes the limitations real. Now, the portability issue is also important. Workers today change jobs frequently. A government-linked account that follows the worker could reduce friction. A worker may drive Uber for part of the year, work retail part of the year, contract for a company, and then take a full-time job later. A portable IRA can follow that worker. This is more aligned with the modern labor market. The employer-based retirement system was built for a different world. The Trump IRA appears designed to reduce the gap between traditional employees and more flexible workers. That is structurally significant. The question is whether it will be implemented cleanly. Will the investment options be sound? Will fees remain low? Will account administration be simple? Will people understand tax treatment? Will income eligibility be easy to determine? Will there be fraud controls? Will government contributions arrive reliably? Will workers be able to withdraw early, and if so, what penalties apply? Will the program interact with existing IRAs? Will it reduce or complicate other retirement savings options? The source document does not answer all of these, and I will not invent answers. The point is that the executive order is only the beginning. Implementation will determine the real effect. A good idea can fail if executed poorly. A modest idea can become powerful if executed well. Not too ye, let us think as an investor. If more money is moving into the stock market starting in 2027, what does that imply? First, broad U.S. equity funds may have another source of demand. Second, large index constituents may benefit from passive flows. Third, financial firms administering low-fee products may see more assets under management, though fee caps may limit profitability. Fourth, market volatility may increase as more retail money participates. Fifth, inflation hedges may remain important if the program contributes to deficits and money creation. Sixth, cash savers may continue to lose if the dollar is diluted. Seventh, market crashes may become larger buying opportunities for people with discipline. The core investor response is not complicated. Own productive assets, keep fees low, use tax-advantaged accounts when appropriate, understand government incentives. Do not rely only on wages. Do not let inflation destroy idle cash. Keep liquidity for downturns. Buy good assets when they are on sale. This is how one survives and benefits inside an inflationary debt-driven system. Now, let us discuss the phrase, own where the money is moving. This is a key investment principle. When a policy creates a flow, assets receiving that flow can benefit. 401ks created flows. IRAs created flows. Free brokerage apps created retail flows. Government stimulus created flows. Quantitative easing created flows. The Trump IRA, if it works as described, creates another flow. The money moves from workers and government matches into retirement investment products. Those products likely buy public markets. Therefore, public markets receive demand. But flows can be temporary, slow, or smaller than expected. So you do not invest solely on the announcement, you monitor participation. You monitor contribution levels, you monitor fund options, you monitor government funding, you monitor actual asset flows. A signal is not the same as a confirmed trend. Smart investors distinguish between policy intent and realized flow. Now, there is another subtle implication. If fees are capped very low, the program may push the broader retirement industry toward fee competition. If workers see a 0.15% cap, they may begin asking why their existing 401k options charge more. That pressure could be positive. It could force employers and plan administrators to justify high fees. It could increase awareness of expense ratios. It could shift more money toward low-cost index products. This would be good for investors generally. Financial education often begins when people see a comparison. If someone learns that one plan charges 1.26% and another charges 0.15%, they begin to ask better questions. That questioning can save them tens or hundreds of thousands over time. In that sense, the Trump IRA debate may help even people who never use the account. It may teach them to look at fees. That is valuable. Now let us talk about the dangers of political branding. Calling it a Trump IRA means the account may become emotionally tied to politics. Supporters may like it because of the name, opponents may reject it because of the name. That is a mistake on both sides. A retirement account should be analyzed by rules, fees, match structure, tax treatment, investment options, funding, and risk, not personality. If the account is useful, use it. If it is flawed, understand the flaw. Do not let political emotion decide financial behavior. This is true for every policy. Your portfolio should not be run by tribal identity. It should be run by principles. Now, what are the principles? First, take matching money seriously if it is genuinely available to you and the terms make sense. A match can be one of the highest return opportunities in personal finance. Second, fees compound against you. Lower fees matter. Third, access matters because systems drive behavior. Fourth, portability matters because modern workers move. Fifth, government spending must be funded somehow. Sixth, debt. Funded benefits can create inflation pressure. Seventh, inflation punishes cash and wages more than productive assets. Eighth, more money flowing into assets can support asset prices. Ninth, market support does not eliminate crashes. 10th, crashes create opportunities for people with cash, patience, and a plan. These principles are more important than the name of the account. Now let us think about the average worker. Suppose a worker does not have a 401k they earn under the income threshold. They can contribute $2,000 per year. If the government contributes $1,000, that worker now has $3,000 going into an investment account annually. If fees are low and the money compounds for decades, the effect can be meaningful. Not because $1,000 is enormous, because the match accelerates the early base. The early base matters. Compounding needs capital and time. A match provides extra capital. Low fees preserve more of the return. Portability keeps the account attached to the person rather than the employer. That is the favorable case. Now suppose a worker qualifies but cannot contribute enough. They may receive only partial benefit or no benefit. In that case, the policy may not reach the person fully. This worker still faces inflation if the program is debt funded. That is the limitation. Now suppose an investor is already financially savvy. They may not qualify for the government match because income is too high, but they can still learn from the policy. More money may flow into markets. Fees matter. Deficits may rise. Inflation pressure may continue. Broad market exposure may benefit from structural flows. Crash opportunities may become more important. The account itself may not benefit them directly, but the system effects may. This is why investors study policy even when they are not the direct recipients. Policy changes flows. Flows change markets. Markets create opportunities. Now, let us return to the government debt. A government that brings in $5 trillion and spends $7 trillion is already running a large deficit. If it adds new spending, it deepens the challenge unless it cuts elsewhere or raises revenue. Deficits can continue for a long time when a country issues the world's reserve currency. The United States has that advantage. But advantages are not unlimited. The more the government borrows, the more it depends on buyers of its debt. If buyers demand higher yields, interest costs rise. If the central bank intervenes to keep financing conditions easier, money creation can increase. That can weaken the dollar over time. This is why policies that seem small individually can matter cumulatively. One program is not the whole debt crisis, but every new unfunded promise adds to the pattern. The pattern is the problem. And once you see the pattern, you understand why asset ownership matters. If the currency is being diluted gradually, people who own productive assets have a better chance of keeping up. People who hold only cash and wages may fall behind. This is the economic machine the source document is trying to reveal. Now, the solution is not to be cynical. Cynicism is useless. The solution is to participate intelligently. If a legal account offers a match and low fees, use it if it fits your situation. If you have a 401k with a match, capture it if possible. If you have old accounts, manage them. If you invest in funds, inspect fees. If the government prints money, understand inflation. If more money flows into stocks, own productive assets. If crashes happen, buy quality when prices fall. If you cannot contribute much, start small. If you can contribute more, automate it. If you do not understand investing, learn. This is how you move from victim to participant. A person who does not understand the system says everything is getting more expensive and I do not know why. A person who understands the system says money creation dilutes currency, debt drives policy. Asset prices respond to flows, and I need to own assets instead of only holding cash. That difference is enormous. Now, I want to be clear that investing involves risk. A total stock market fund can decline. The S&P 500 can decline. Retirement accounts can lose value. If someone invests at a market high and a recession follows, the account may be down for a period. This is not a savings account. This is long-term ownership. The correct investor must have time horizon, diversification, and discipline. Do not invest money needed for rent next month. Do not use retirement accounts as gambling accounts. Do not borrow to chase the market because a new program exists. Do not assume government support makes markets safe. Markets are never safe in the short term. They are tools for long-term wealth creation when used correctly. Now, let us connect the Trump IRA to the broader retirement problem. Many Americans are underprepared for retirement. The cost of living is high, savings rates are low. Employer pensions have largely disappeared for private sector workers. 401k has shifted responsibility from employers to employees. That means individuals must save, invest, choose funds, manage fees, and stay disciplined. Many people were never taught how a new IRA may help access, but it cannot solve the education gap alone if a worker contributes. But chooses poorly, the outcome may disappoint. If a worker panics during downturns, the outcome may disappoint. If a worker withdraws early, the outcome may disappoint. If inflation remains high, the real outcome may be weaker than expected. Retirement security requires more than an account. It requires a savings habit, good investments, low costs, patience, and policy stability. The Trump IRA addresses some parts of the problem: access fees, portability, small minimums, potential government match, but it does not eliminate the need for financial literacy. That is the larger message. Now, the source document also says the 401k is not portable and can make people feel stuck. The psychological effect is real. People often do not fully understand their benefits, so they overestimate the cost of leaving a job or underestimate the rollover options. A portable account can make people feel more independent, that can improve labor mobility. If workers can leave jobs without worrying about retirement account access, they may make better career choices. Better career choices can increase income. Higher income can increase savings. More savings can increase investment flows. This is another indirect effect. Retirement design affects labor behavior. Labor behavior affects wages. Wages affect contributions. Contributions affect markets. Again, systems connect. Now, let us think about potential unintended consequences. If government matches push more money into equities, valuations may rise. Higher valuations can reduce future returns. If low-income workers enter markets near elevated valuations, future returns may be lower than historical averages. If inflation rises from deficit funding, real returns may be challenged. If people think the government match means risk is removed, they may take too much risk. If politicians change the rules later, confidence may be affected. If the program becomes expensive, future Congresses may modify it. If workers rely on it too much and do not build emergency savings, they may withdraw early. These risks do not make the program useless. They mean it must be used intelligently. A financial tool can help or hurt depending on behavior. Now, what would I tell an ordinary worker? Do not wait for the perfect account before investing. If you already have access to an IRA, 401k, Roth IRA, brokerage account, or employer plan, begin learning. Now, if a new Trump IRA becomes available and you qualify for the match, study the rules if you can afford to contribute enough to capture the match without destroying your emergency fund. It may be a very attractive opportunity. Choose low, cost-diversified investments when appropriate. Do not panic during market declines. Understand that government money has a cost somewhere in the system. Invest because you want to own productive assets, not because you think the government can eliminate risk. Now, what would I tell a financially savvy investor watching from the outside? Track whether the program actually launches in 2027. Track participation, track fund options, track asset flows. Track whether the estimated $32 to $68 billion of inflows materializes. Track whether flows concentrate in total market funds, SP 500 funds, or other vehicles. Track the inflation and deficit impact. Track whether the program changes market psychology. Track volatility. Use this information not to blindly buy, but to understand the direction of liquidity. Liquidity is one of the most powerful forces in markets. When liquidity expands, asset prices can rise. When liquidity contracts, asset prices can fall. The Trump IRA is potentially another liquidity channel into equities. That matters. Now let us close by returning to the deeper issue. The old retirement system was built around employers, but the modern economy has millions of workers outside that structure. The Trump IRA is being presented as a way to bring those workers into the investment system that could be beneficial. But the government is already in deficit. So the match is likely funded by more debt if taxes are not raised. More debt can mean more money creation. More money creation can mean inflation. Inflation hurts wages and cash, but the same money flowing into stocks can support asset prices. Therefore, the people who understand and participate in the asset system may benefit. The people who do not may fall further behind. That is the core contradiction of modern policy. Governments try to help people by giving them dollars. But if the dollars are created through debt and monetary expansion, the value of all dollars can weaken. So the real solution is not just receiving dollars, it is converting dollars into productive assets intelligently. That is what retirement accounts are supposed to do. The account is only a doorway. The real wealth comes from what is owned behind the doorway: businesses, earnings, dividends, cash flow growth, compounding. If the Trump IRA helps more Americans cross that doorway, it could be meaningful. But if people think the doorway itself is wealth, they will misunderstand it. A retirement account does not make you wealthy. Saving, investing, low fees, time, and discipline inside that account can. That is the principle. So do not look at this as only a political announcement. Look at it as a signal. The government wants more workers investing. It wants more money entering the stock market. It wants a new path for people. Without 401ks, it is willing to use public money to create that path, but public money comes from taxes, debt, or money creation. That means opportunity and risk arrive together. Your job is to see both. Use the opportunity if it fits, respect the risk, own assets. Keep fees low, prepare for volatility, and understand the system well enough that when new money moves, you know whether you are standing in front of it, behind it, or completely outside the flow.